I once had a successful investor tell me, "I never get into a plane without checking that the destination is correct. Why would I invest in a company if they do not know how they plan to exit?" I think the exit slide is one of the most important slides in your investment deck. There are a few common mistakes with the exit slide that I often see. The first being to blandly say, "We will exit via a trade sale or IPO in 3 to 5 years' time." This is longhand for "we do not know." So either give me a plan or state that you are waiting to make a plan later. Another common mistake is when you describe your exit strategy simply as an acquisition by a large company such as Google, Amazon or Facebook. This is so easy to say, but how are you going to make it happen? This is more believable if you state the connections that you have with these organizations and why they need you. Another mistake that I commonly see is an exit too far away. Typically, investors are looking for an exit in around 3 to 5 years. Less than 3 years could affect their tax situation for personal investors, commonly called business angels, and many funds have to have an exit within 10 years of the fund creation. So most investors look for an exit in the 3 to 5 year time scale, knowing that things tend to slip. Let's be clear. There are very few investors who are not looking to make an exit at some point. Creating a profitable, growing company, unless it can return money to the investors, is generally not interesting. This surprises some first-time entrepreneurs. So your job is to explain how your investors will make a return on their money, the money that you took when you sold them shares in your idea. In another video, I will talk about how you can value your company to understand how many shares you might sell in return for investment. But the key point I want you to absorb is that you are never giving away your company, but actively deciding to sell part of it in return for money. Later, your investors are likely to be selling their shares to someone else to generate wealth for themselves. Your job is to provide a scenario that helps investors understand the options that your company might have in the future. This is different than the company being profitable. Sometimes, trying to predict an exit is a leap too far. Concentrate on explaining how you'll break the mold and be a great disruptor. Very few things are truly disruptive, so this approach should be used sparingly as it opens up as many questions as it answers. Only a few investors will be happy with the approach, build a big community and worry about the value extraction later. You can use this as a plan, but expect to be challenged upon it. Explain how your customer base will quickly grow and why they are valuable customers. There are 3 main ways that an investor can extract value from your project. They are initial public offering or IPO, the sale of the company to another organization, known as a trade sale, or by returning part of the money you earn from customers, known as revenue distribution. The classic IPO. Here you sell your shares on a stock market, typically the AIM market in the UK, which is part of the London Stock Exchange, the FTSE. AIM means Alternative Investment Market, and it is designed for smaller companies. It costs around £250,000 to £500,000 and takes around 3 to 6 months to do an AIM flotation. In a trade sale, you sell your company to another organisation. This could be another company who is buying you for your assets, the customers, the technology, or it could be an investment fund that is buying you as part of their investment methodology. It is normal that the investment fund will sell your company or float it, either in whole or in parts at a later stage. This tends, but not always, to be the way that most UK companies create value for their investors. It has been argued that compared to the US, we tend to exit earlier and at a smaller size than US companies. Knowing when to exit is a tough choice, and each situation is different. If you are describing a trade sale as your exit route, remember who will buy you, why, and how will you let the potential acquirer know that you exist. Revenue distribution. This is a specialised exit and tends to be used for things like film production, but it's very rarely used for product and consultancy companies. In this approach, you share part of your return with your investors. It might be a percentage of your revenue, or more likely a percentage of your profit. When at the family and friends stage, many early stage companies use dividends to return value to their shareholders. Revenue distribution tends not to be liked by the VCs, as they need to convert all their assets to cash at the end of their fund life. Let's take a look at an exit slide. This is just one approach that you can use to describe your exit, here via trade sale. As you can see, we are explaining why the acquirer would want to buy your company. In this example, this is the opening of new markets and revenue. Then we explain if the acquirer has a history of buying companies, and then give a few examples. Another way of tackling this is to list companies similar to yours that have been bought and who bought them, why they were bought and for how much. This is more typical in acquisition-rich sectors. It is a changing world. If you say at this stage that your exit will be an IPO, then along the way you get a compelling trade sale offer, you and your board will make a suitable decision then. So don't think because you predict one future today, you cannot change your mind. Be confident and remain flexible. How do you find real-world examples of other companies' exits? This used to be a really difficult and opaque process. Things have really improved, and I have found that the subscription services, such as Bowhurst, really useful to see other exit examples. Another approach is to speak to other entrepreneurs and see what they know. Similarly, ask your professional advisors like your accountant, lawyer and IP agent for the information that they might have. It is time for me to make my exit, and as Tom Stoppard once said, every exit is an entry to somewhere else.